Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator for startups in the world. We run it out of Silicon Valley with the mission of helping 1 million entrepreneurs reach $1 million and beyond in annual revenue. And let me also wish you a happy Valentine's Day. You know, I got an email from a friend who saw the regular newsletter that we send out every week with the, schedule for today. This morning we have a roundtable, and then in the evening we have a rendezvous today. And he said, interesting way to spend Valentine's Day. So I wrote him back and I said, as you know, I love my work. So happy Valentine's Day. I'm very happy to spend it with you. So this is our 386th 1M1M roundtable. And we've been doing these free mentoring sessions for a long time. We started doing these in the fall of 2008, and this is the experiment that led us to develop the full-blown 1M1M program, which today has a footprint of 500,000 people, and we, serve a very large community with lots of different touch points. You'll find out about those in the course of the presentation today. The event is being recorded. You will have a recording available on our YouTube channel, 1M1M Roundtables, and there's lots of recordings of all prior roundtables and other content. It's a great channel. So if you have time and you're looking to learn about entrepreneurship, it's a great place to go hang out. Our Twitter handles are at 1M1M and at Srinagar. Maybe you already follow them. If you don't, please consider following them. Again, we publish a lot of interesting content through our Twitter channel. And if you're live tweeting today, please use hashtag 1M1M. These are the call-in instructions. This is a round table, not a broadcast. So we want you to participate as much as possible. I will put this slide back up later, and you can call in and weigh in, ask questions, so forth. We're going to start today with a conversation with Daniel Cohen. Danny has had a long history in venture capital, and he's dialing in today from Israel, and he's now general partner of Viola Ventures. Danny, I'm looking forward to learning about what Viola Ventures is and where you are today.
Perfect.
So let's start by introducing our audience to you, Danny. Just give them, I know you, I've known you for a long time, but tell them about you a little bit, as well as introduce Viola Ventures, which I don't know much about yet.
Yeah, in fact you do, but I'm not, but you'll be very familiar in a second. So as Shamana said, first of all, thanks for hosting me today. We've known each other, I guess, for over a decade now, which I think you're still the same age we met 10 years ago, but the rest of us are getting older. Quickly about myself, so I've been in venture capital for about 17 years, starting in 2001 with another Israeli-based firm called Gemini. I was there for 12 years, and I moved to another Israeli firm, Carmel Ventures, about 5 years ago. And just about 2 months ago, Carmel, we rebranded ourselves to Viola Ventures, and I could talk about that.
Okay.
And we raised a new fund for $220 million for early stage, and that's basically where we are today.
Okay. And what is the focus of Viola Ventures in terms of industry segments, stage, check size? Let's get our audience acquainted with Viola Ventures and the investment.
Sure, absolutely. Absolutely. So first of all, Viola Ventures is part of a larger Viola team. So Viola at whole is actually a combination of 4 different funds. Different funds with different strategies. I'm a partner at the venture side, and we're an early stage firm. As I said, we raised just $220 million just last month. That means we focus mostly on A rounds. I would say our typical check size is between 2 million to 10 million. Seed, A rounds, sometimes B rounds. Anything in the broader sense of technology. It used to be well-defined, and we can talk about that. The world today, it's expanded to many verticals and many areas. We don't do healthcare, but anything that is in tech-related, we will do. And our major geography focus is Israel, or what's called Israeli-related. Israeli entrepreneurs now expand across the globe, and we try to reach any Israeli-related firm, either in the U.S., in Europe, or in Israel. We have done some deals that are not Israeli connected, but I would say that's 90% of our deals are somewhat connected to Israel.
And when you say you don't do healthcare, you don't do healthcare IT either, or you do healthcare IT but don't do pharma and biotech?
Yeah, we don't do pharma and biotech. We will do healthcare IT. Again, I think if you look at, as I said, I think 10 years ago, the definition of tech was, I think, much more well-defined. Now we've expanded to many verticals. We look at agriculture. We look at automotive, of course. We look at healthcare. So it's very wide, and the opportunities are across many verticals.
That's pretty much our sweet spot as well. We don't do pharma or biotech either, but we do healthcare IT. So I think that's how the whole IT industry's venture and startup ecosystem is operating. So let me ask you a question, double-clicking down on the stage, and especially the early stage. So to write a $2 million check, what do you want to see accomplished in the entrepreneurial team already? Like customer validation, paying customers, revenues, what level of validation are you looking for to consider it a viable Series A in your definition?
Yeah, so first of all, it really changes from vertical to vertical, and it's not one size fits all. I think there has to be some, if you look at the three key components of a startup, right, which is the market, the team, maybe technology, maybe traction. I would say one piece of those needs to be exceptional enough that the risk is off the table. So if if it's a new team with no traction, no development at all, going for a questionable market, that of course will be very difficult. So I think we look for at least one of these components to be in place where we can put in the $2 to $3 million. Have we done deals that are pre-launch? Absolutely, we did that, right? Where we believe strongly in a market, when we think the market is so unique that the opportunity, we're willing to take the risk pre-launch, or when the team is such that we've known them and worked with them and we feel that they've proven enough that we can back them pre-launch.
Okay. Now, let's talk trends. You've been in venture capital for a long time, and you've seen the evolution of, the various different trends that we have seen. I mean, you and I have both been in this industry for over 20 years, so we've seen a lot. So let's talk about the 2017 vintage. What is in the deal flow? Like, if you look back at all the deals that you've seen in 2017, what stands out as trends?
Yeah, so I think before I look specifically at our deal flow, what happened, I want to mention something that we at Viola think is very critical. We believe we're in between innovation cycles, and that has been going on, I would say, for the last 12 to 18 months. So if you look at the previous innovation cycle, which was about social and mobile and everything that came together, I think, in 2007 with the iPhone and related, that was a very long innovation cycle that really has matured in the past 12 to 18 months. And it's much harder to find a compelling SaaS deal early stage or a compelling mobile app. Those exist, but it's much harder than before. And we're kind of waiting, or we're seeing the new innovation cycle, which is all about what we call now frontier technologies, drones, automotive, IoT, sensors, all these amazing things. Those are starting to emerge, but they're not yet at the point where it's full-blown, the deals are generating the real revenues yet. And in between those innovation cycles, I think creates a little bit of confusion in the market. But when we focus on that, and especially when we look at what's happening in Israel, I think last year for sure was the year of automotive. We've seen an explosion of anything related to the automotive market. That would be one thing. And of course, the second big trend is everything .ai, right? Every company is something related to AI. Sometimes it's real, sometimes it's not. But those, I would say, are the major trends of 2017.
Yeah. And let's talk a bit about your portfolio. What are the highlights of your portfolio? And as you describe some of them, give us a window into your thought process of when you saw the company first, what did they have that looked so attractive and compelling that you chose to invest in them, so that our audience can get a sense of how you think about these companies?
For sure, absolutely, and I will try to highlight maybe 2 or 3 companies from different stages. So I think our probably right now our most advanced company is a company called ironSource. It's a company based in Israel. They do application distribution. So if you want to distribute your app on any mobile or app store, they help you with that. Facebook is always a way to promote your apps, but they are the largest alternative to Facebook out there in the market. It's a big company generating real profits at revenues of hundreds of millions of dollars. We came into that company about 5 or 6 years ago, and their story was all about traction and very strong monetization. So in fact, the story is that they came to us, they had already some very nice revenue going for them, and they thought they will bootstrap all the way to the end, and we convinced them, or one of my partners convinced them, that they need help and support in building a billion-dollar story, and we came in with a relatively large check early on. So I think the story back then, 5, 6 years ago, was that the world is not going to be only dominated by the big tech companies for app distribution. Of course, that the app economy is going to explode through the roof. That happened in a very big way, and of course, we're now enjoying that very much. So that was, I would say, that story was very much a traction story, if you will. On the alternative to that, I would give a deal we did very recent. It's called NSNox. I think we just announced it a couple months ago. One of my partners did that. And the founder there is the founder of one of the most successful Israeli tech companies called CyberArk. So CyberArk is a cybersecurity company that went public. I think it's worth somewhere between $3 to $4 billion now in the market. And that founder decided to start something new. And I would say, without getting too much into details, somewhere around secure bank transfers in the world of blockchain. So, the right buzzwords, but also a great entrepreneur. So we saw a big market with a very, very strong team. And we backed them even though they had very little to show for from a traction perspective. So if the first story was all about traction, that was all about team. Team. And then the third example I want to talk about is a company started out of Israel, but now headquartered in San Francisco, called Pulse. Pulse is a company that started from, the original name was Cell Savers. They started from doing on-demand cell phone repair. They expanded into consumer tech services at large. So they will now, on demand, someone will come to your home and hang up your TV or fix your smart home or fix your phone or any tech service that you want at home. The company was seeded by Sequoia Capital. We came in, we led the A round. There was a B round after that. And for us, that story was all about market. So I've been a big believer in the need for tech services at the home. When I met them, it was like right on an investment thesis we had. It was a very quick process. And of course, it's a great team that has great traction.
And what is the Israeli angle on that one, Tony?
What's that?
What is the Israeli angle on that one? Sounds like it's an American deal.
No, it started in Israel. When we invested, they were in Israel, but the CEO relocated to San Francisco.
San Francisco, got it. All right. And let me actually give me a segue into a question that is more of a broader trend question. For a few years, I would say the peak of this was probably 14, 15. We saw unicorn mania sweep all over Silicon Valley, and then it got exported, actually. I mean, India went through a unicorn mania phase and so forth. So what is your experience in Israel vis-a-vis unicorn mania? It has slowed down somewhat, but still there's a lot of late-stage capital that is going into late-stage deals, and some of these are questionable valuations and really questionable terms. So how do you parse unicorn mania?
Yeah. First of all, it's amazing how the word unicorn went from, when it was kind of attached to our ecosystem, started from a very positive thing, and now it's become something that is always a little bit questionable. I think you touched on some very important and key points. So one, clearly it's slowed down. There are less companies that are reaching the billion-dollar valuation and above. I think a few things are happening. One, it's still the amount of capital that's going after growth stage is still very high, and actually it's growing. We see it in our local market in Israel. Of course, it's happening in the U.S. I think it's happening globally. And I think a lot of companies that maybe 20 years ago would have gone public now want to remain private and take private money and are willing to go through these growth rounds. That trend is still happening with us. I think a few years ago, it was really about, I'll get to the billion-dollar valuation, and I don't care about the terms. And I think many companies that on paper were valued at a very high level, unrelated to their economics, had attached terms to them that didn't make sense. For us at Viola, we're very critical about that. And when we invest, we take very clean vanilla terms, non-participating. We expect the company to continue to get vanilla terms across their growth. And we're willing to take lower valuation and not be a unicorn for clean terms versus getting a very high valuation with some more difficult terms that I think come back to haunt you later on. And I think that's one of my most important tips to entrepreneurs, definitely at the A round, but all the way through the growth stage.
Try to keep your term sheet clean.
Absolutely, absolutely. And, you know, any time in the past that we've moved or we compromise on that, I think we've learned to regret that. So absolutely, if you can keep it clean, try to do that as long as you can. I think overall now growth capital still exists. You know, we have companies that have raised over $1 billion in the past 12 months. I think on multiples that make a lot more sense, especially in Israel, we see that. So I think the world where a company selling for $50 million is worth $2 billion, I think those days are a little bit over.
What is your read of the Series A gap? And I'm going to elaborate a little bit on what's happening here. We have now over 500, I would say probably more like 700 micro VCs who have brought in a lot of capital into the seed stage. And some of these are really small funds, you know, $10 million, $15 million funds. Some are $30, $50 million funds. Some are $70 to $100 million funds. But you could say it's pre-Series A ecosystem. And in some cases, they do small Series A, 2 million Series A kind of deals as well. Is really active. And this is a very recent phenomenon. I think this has happened only in the last couple of years, maybe even the last 18 months. Huge numbers of people have raised small funds. So as a result, a lot of seed deals are getting funded. And this happened with more seed deals getting funded, happened with a lot of angels funding them starting in 2013, I think. And a lot of these angels have now formed micro VC funds, which brings in even more capital into the system. So in 2013, there were, I think, 70,000 investments in the seed stage. Now I think it's more like 100,000. I don't think we have a concrete number for 2017 yet, but I think it's closer to 100,000. And then the Series A onwards number is, you know, 1,200 to 1,500. So a lot of companies don't make it from the seed stage or pre-Series A stage to Series A. What do you see in Israel? Is there a parallel of this phenomenon in Israel? Is it different in Israel? How do you compare the Israeli ecosystem with this phenomenon?
Yeah. First of all, I think I think you're spot on. I think this is happening globally, and I think it's now, I wouldn't say it's an issue, but it's just definitely something we live in our industry. And I think entrepreneurs need to be very thoughtful when they take the seed money, is to understand where it takes them. And I think I would say, when I look at the seed companies, I would put them in 3 different buckets. I think one bucket is companies that they take the seed stage, things don't work out, and they shut down. That's always a part of the entrepreneurial story. I think some of them, the seed stage brings them to self-sustain, and the whole idea is to raise seed and then exit at a small amount. In Israel, that's happening a lot, where angel investors or small seed funds are trying to make small investments and convert them directly to exit without going through the whole life cycle of the investment. And of course, the third kind is the ones where they do a seed and then they expect to raise the A round. It's tough to move from the seed and the A round. And I think what we're telling entrepreneurs is, one, raise a little bit more at seed stage than normally. So if you can take, instead of 1 million, 2 million, if you can take instead of 2 million, 3 million, even for a little bit more dilution, you might want to do that because it will get you to a better, to more proof points. That would be one thing to think about. And the second is to really think hard, what is the financial milestone that you want to reach, and how do you spend your money in a way which makes it easier to fundraise? And I think entrepreneurs don't think about that enough. They raise money, they work on product, they work on launch, they work on all these things, and they come with a little bit on all fronts instead of focusing all their effort on one area that is going to get them the A round, and use that to leverage the A round. And the good companies know to do that, and that's really what needs to be done.
Well, and the truth is, unless you have a team that has real track record, to raise Series A, you're going to have to show traction. These days, people do not fund Series A without traction unless you have a very particular situation. You're a repeat entrepreneur who's already made money and stuff like that. So ignoring traction or ignoring the quest for traction, with seed money and without Series A is a dangerous path to go down.
Yeah, but can I comment on that just for a second? I think you're absolutely right. I think the question on traction, and I just had lunch, with an entrepreneur today, and we had a very interesting discussion about that, is that what kind of traction? And for me, one of the most important things I tell entrepreneurs is that try to do a small launch. Try to get a traction in one city or one vertical or one geography or one place where you show maybe it's not a big traction, but if it's condensed and it's one small area, you can very easily tell a story of, I got something small here, give me money, I'll make it bigger, versus kind of a little bit here, a little bit there kind of traction.
I agree. I think you need a market penetration strategy that starts to show that, yes, you can sell, you can convert your, concept to a revenue-generating product, and then have some thesis about repeatability. And repeatability is everything. And you have to do a high-velocity company. Repeatability is everything.
I agree.
So the other point that you made, which I think is very interesting, and I am very bullish about this one, which is, people do small amounts of seed financing and then go seek exits directly. I think this is, we're in 2018. The internet, as we said earlier in the program, that you and I have been around in the internet ecosystem for more than 20 years. So a lot of things have happened already. A lot of things have been built. It's not like there are wide open opportunities for, billion-dollar, multi-billion-dollar companies left, right, and center right now. But there are lots of niche opportunities. So if you can build a niche, you can find product market fit in a niche that somebody else's channel can, leverage and build a big business out of, or even a mid-sized business out of, that is actually, for an investment and even for entrepreneurs, that is a very reasonable strategy, and I would say a very good strategy. What do you think?
First of all, one, I totally agree. And I would add to that the acquirers in the market have expanded dramatically. So maybe 10 years ago, the acquirers were just the tech companies. Now, every company, every Fortune 500 company is out there in the market looking for innovation, looking for digital, looking to bring teams that bring the entrepreneurial and startup spirit. So if you're a small company with good product market fit, there are a lot of opportunities to get an exit. I think what's related to it, and related, for example, to us, you need to make sure that the investors that you have are aligned with that strategy. So for us as investors, when we have a fund, which is a $220 million fund, for us to put $1 million and get back $4 million, I mean, not bad, but it's not interesting. Yeah, it doesn't move the needle, right? So if your strategy is keep it small, try to hold a lot of the company and sell it for, you know, somewhere between 10 to 50, just make sure you have investors that are aligned with that strategy. Otherwise, it creates, you know, undesired tension, I think.
Yeah, but the truth is there is a lot of, you know, lot of participants who would be willing to put in a small amount of money and get a good exit. You know, there are lots of 15 million funds, 20 million funds out there who would be a good fit for this kind of strategy. But I think the flip side of this, Danny, is I also hear a lot of 15, 20 million funds saying that they want to invest in unicorns, which is very tricky, I think, because they can get absolutely wiped out through liquidation preferences and so on and so forth.
Yeah, it goes back to, as long as you keep the deal terms clean, should be okay. But goes back to our previous conversation.
Right. You know, the other pointer, audience, that I would like to give you is read my opinion piece recently called SaaS Companies, You Have an Unprecedented Opportunity. There are tons of SaaS companies that are doing 50, 70, 100, $200 million. This is not Fortune 500 or Global 2000. This is, you know, mid-sized companies that are looking to acquire, you know, doing tuck-in acquisitions that will give them another product line to sell through their channel, maybe another $100 million, $200 million, you know, business to graft onto their trunk. And that you can play into that if you have a cap table that supports that kind of a play. If you have taken in $10, $20 million, then that's not going to be the path that you can go. But if you can do a capital efficient business, then you can play in that sweet spot as well. Okay, Danny, any other thoughts that we should communicate about the Israeli ecosystem to the audience?
Yeah, I would just want to say that I think, yeah, one thing about Israel, which I think is interesting, I'll say two more things, that Israel is, of course, going after global markets. So we have startups now not only going after the U.S. market, but also after going after Europe or China or Japan or India.
Yeah.
And two, that Israel is great in the sense that we have a little bit of everything. So we feel that we're the most similar place to Silicon Valley in the sense of the diversity of the type of startups we have. So I'm quite excited and looking forward to a great 2018.
Do you have an example of a company from Israel that is being successful in, let's say, the Indian market? We have a very big penetration in India.
Yeah, I'm trying to think if I mean, we have, you know, we're investors in a company called Redis Labs, which is empowering the open source database of Redis. And I know Redis is extremely popular both in India and in China. I need to think if, unfortunately, not off the top of my head, I can't think of one of our companies that is dominating, you know, that India is like more than 50% of the revenue. I need to think about that one. Don't think I have one right now.
Okay, well, let's create one.
Yeah, for sure. Absolutely. I'll take that as an action item.
On that note, thank you for coming, Danny. It was a pleasure speaking with you.
Thanks for hosting me, and I really enjoyed it. Thank you so much.
Bye-bye. Folks, we are going to move to the entrepreneur pitch section of the presentation. Just know one thing about the spirit of this. This is a working session. You can feel completely safe. We have no other agenda but to help you fine-tune your strategy and, you know, remove your roadblocks and discuss with somebody who understands what this game is all about. That's all there is to it. So don't feel like you need to be defensive or nervous or embarrassed, nothing. It's a working session. We know that you have a raw situation. You're an early stage startup, so of course you have a raw situation and we're going to work on it together. The one thing that you need to note also is that it's okay that you disagree with my feedback, no problem. It's your company, it's your strategy, you'll do whatever you want with it. So don't feel bad if you disagree with the feedback. You take the feedback, think about it, do what you want. But remember one thing, and this is not negotiable, not all businesses can raise money. Over 99% of the businesses that go to seek financing don't succeed in raising money for a lot of reasons. Raising money does not guarantee success, and not all companies should be raising money, especially not gobs of money. You just heard a little bit of a discussion on alternative strategies of doing capital efficient, early stage product market fit development and getting some early customers and then seeking an exit early on if you do not have the ingredients of seeking a billion-dollar kind of company that would fit the venture capital model. There are different types of companies should go through a different financing strategy. So it's not a one-size-fits-all kind of scenario. Please keep this in mind and do not, single-mindedly pursue financing. That's the wrong way to look at entrepreneurship. Okay, we are going to start today with Mithun Kadur of Sagisu, and Mithun is actually a premium member of the 1M1M program. So Mithun, go ahead and tell us what you're working on.
Good morning, everyone. Thank you for the initial discussion with you and Daniel. Very great insights there. Great insights for us, great insights for everyone as well. Sagisu, the name sounds very Japanese. Sagisu does not mean Shiro Sagisu. Shiro Sagisu is a singer, but we are referencing Sagisu from an Indian language from Kannada. Sagisu means transport, and that's the history behind the name of our company itself. Next slide, please. I want one of the very core philosophies we believe in is in the founding team and the people who we bring to table in creating something very unique to the market. With respect to what we're doing, I just want to give a quick intro of myself and the team here, and then I'll go about talking about what we're doing, how we're doing, and where we are in our journey. This is my second startup. We've been bootstrapped till most recently. We started our operations in May of 2017, and we have created Sagisu to disrupt the commercial transportation space. We are trying to connect supply and demand in the most efficient manner. Ajit Nair is my head of technology. He runs our technology. He's been with me from day one. And we met at Hell's Kitchen, New York, and the journey has been excellent to date. Nagesh Rajana is advising us. He was most recently the CEO of Bombay Dyeing in India, and he is advising us on how do we penetrate into the Indian geography with respect to commercial transportation and supply chain world itself. Bernard Thomas is our advisory here in the U.S. He brings in deep expertise from SiriusXM, Comcast, and Bed Bath & Beyond, and helps us with customer experience. Operationally, the leadership in our organization is run by Bharat. Bharat comes from Ola, and he brings a lot of aggregation expertise in the past, and he is running our operations, sales, and supply. Darshan is our, he's from Germany Mobile Media Wing and runs our product. Next slide, please. So what is our mission? We're trying to solve the supply chain and logistics problem and take the inefficiencies out of commercial transportation. We think the Indian logistics market is ripe for disruption. We see a lot of inefficiencies, and we are in a mission to reduce the inefficiencies and pain points using building technology being our differentiator. Next slide, please. So we have three stakeholders. One is the large enterprises of businesses. The second is drivers of truckers. And third is the customers of these enterprises, which are mostly distributors and small businesses. I'm not going to read every pain point here. I'm going to talk about holistically. Shippers today don't have reliability. Reliability is one of the biggest challenge with respect to the large enterprises. Next slide, please. carriers and drivers, if you see, on the driver side, they don't have the right tools with them to be more efficient or to connect with demand in the most efficient manner. Some of the shortcomings have been like onboard computing. No drivers or truckers have had onboard computing due to the lack of network itself. And most recently, we are seeing 3G penetrate into the Indian market. As it becomes better and better, the technology and tools available for carriers and drivers could get better and better. So that's one of the problems what they have.
Mithun, I have one question here. When you say
Sure.
driver, you're meaning a driver with a vehicle, not just a driver
That's right.
with vehicle.
That's right. Driver come owner who owns a truck or a transportation company that has around 10 to 15 trucks or 20 trucks and so on.
Got it. Okay.
Next slide. The distributor and small businesses today, one of the biggest concerns is I don't have visibility. I don't know when the product is coming. So these are the kind of challenges we have seen in the three stakeholder per se. And next slide, please. So we created an ecosystem or a software platform that connects all three parties involved in the most efficient way. We are in the early stages of building this platform. We have a Android-based solution, we have an iOS-based solution, and we also have a web-based solution. That is our state of today with respect to technology. Next slide, please. Now, let me try to give you an understanding of what is our value proposition to our customers. And when we say our customers, it is mostly enterprises, the large enterprises. We're trying to ensure we help them with reducing cost per mile. We're trying to help them with increased reliability. We're trying to help them with reduced shipping times. We're trying to help them with increased visibility. We are also we put our first foot into the door in trying to reduce their OPEX and CAPEX expenditure. I'll throw some light on that at a later point in time. When you say reduce cost per mile, what we are trying to say is if we increase the utilization or if we reduce the empty miles, then the cost per mile automatically drops down. So those are the value propositions that we are currently talking to our end customers, and they see as a potential opportunity for us to be engaged with them. Next slide, please. So now I want to talk a little bit about, I just spoke about what we are doing. We're trying to connect supply and demand in commercial transportation space. We are in the Indian logistics market. Let me just take a step up 40,000-foot level of what the Indian industry in terms of logistics mean. Today, there are around 5.6 million commercial transportation trucks that is transporting freight with a value of approximately $130 billion. Now, this is not our market opportunity in terms of what we are going after, but this is the overall market size. There are a few more indicators that we have looked into. Logistics today accounts for 14% of India's GDP. That is the second highest, most expensive market in the entire world, China being number one. US is around 8 to 9%. So there is a potential to structure it. It's a fragmented market. There's a potential to make it better. And we've also looked at other variables like e-commerce growth, which adds to shipping, the vehicle sales from light commercial vehicles, medium commercial vehicles. We are seeing a significant growth. So we think this is a potential good opportunity for us to be in business for long term. Next slide, please. So now talking at a very high level, I'm going to break this down as to what we see in terms of supply chain itself or logistics itself. There are 4 or 5 components in logistics on a very high level. First mile transportation, line haul or city to city, intercity. Line haul is another term for city to city, and it's also a term for DC to DC or DC to distributors. And the second segment usually is called line haul or transshipment. Then the third segment is outbound deliveries, mostly from plants or distributors to the end retailers or to their end delivery locations, which could be small or medium businesses. And the last one is the end customer delivery, which is last mile transportation. So we try to look at what are the pain points, where are the opportunities. If you see a green in here, that's an opportunity for us. And we try to size and scale the market itself. If you go to the next slide, we will show you where we want to play on a long term. The next slide, please. So we see that one of the biggest opportunity there is for us to be in the enterprise segment, in the line haul business, where there's a potential to do more business. And we'll also touch upon this a little further. Can you go to the next slide, please? So now I'm going to, this is one of the feedbacks I took from you, Shramana, from the last pitch. We had not done a comprehensive bottoms-up total addressable market kind of a analysis. We went back to the table. We went back to the drawing table. We looked at it from two angles. Who are our two biggest stakeholders? Two biggest stakeholders are our enterprises who are our shippers, and the second one is truckers or drivers. So this model here talks about an opportunity to monetize the trucker or driver side of the story. There are around 5.6 million trucks. If I break this down as 1% of the market opportunity for us, that's around 56,000 trucks. And if I break this down further into small-sized trucks and medium-sized trucks, we are looking at 28,000 trucks on both sides to be enabled on our platform. Then we went and did a research on what is an average amount of miles these trucks run in a day. We see that the small-sized trucks run on an average of 50 miles. The medium to large-sized trucks run at 200 miles. We looked at the revenue per mile. The small-sized trucks have a revenue on approximately 45 cents per mile. The medium-sized to heavy-sized trucks have around 62 cents per mile. We assume 300 days of continuous operation, and we see a potential addressable market of around $1.2 billion if we break this down. And in this, if we figure out a way to monetize the opportunity with our truckers, we are potentially looking at a platform fees of anywhere between 10 to 20%, which could potentially be a $250 million revenue opportunity for us. Now I'll break down the other side of the equation. If you can go to the next slide. So in the most recent budget, the number of businesses that were accounted for in the union budget was around 550,000 businesses. Of these 550,000 businesses, we saw that there are around 225,000 businesses that generate revenue. And of these, we broke it down further into see how many of them have revenue from $250,000, $1.5 million, $1.5 million to $10 million, $10 million to $20 million, $20 million to $100 million, or $100 million and above. In this, we looked at the sector percentage breakdown, which was also on the union budget document that's published. We realized that approximately 30% of these companies are only a target market. The reason we say that is we are only focused on retail, manufacturing, pharmaceutical, e-commerce, and the companies which have physical goods. We're not servicing companies that are in the service industry. So 30% of these companies, if I look at it and see and assume that the supply chain spend is around 4%, which is a typical supply chain spend in any company, and of that, potentially 50 to 55% of the supply chain spend goes to transportation, then the potential opportunity for us here comes to like $1.2 billion. What am I saying here? There is a potential for us to cater to enterprise segment and own transportation as a service for them without them having to manage transportation as they do today. So that's our potential opportunity.
Let me see. This slide, how you explain it is clear. 20% of the trucking fees, that part is clear. So this 250 million opportunity that you outlined here is clear. This one is much harder to understand based on what you've shown. So let me see if I understood it. You're saying that there are about 6,500 businesses in the 1.5 million to 500 million revenue range, and in the applicable sector, it's about 50% of that, let's say 3,000. And then you go through the segments, like 250K in revenue, 278,515, 1.5 million in revenue, blah, blah, blah. So this is a bit, so you're talking about 250K to 1.5 million is 25,613, right?
Yeah. So let me explain what this is saying. Let's take the example of 10 million to 20 million. There are 853 companies that is making a revenue of 10 million to 20 million. Out of that, 30% of these companies are opportunity for us to go after.
In the right sector that has transportation involved.
That's right. That's right. So if I assume the revenue is 15 million on average for these 255 companies, and if I assume 50% of the supply chain spend as transportation, which is like 4.2% or 2%, 2% is potentially the transportation spend, then we are looking at a potential opportunity of 76 million. The 76 million, what we are saying here is, we spoke about in the value proposition, we will help you as Sagisu to reduce your OPEX, number one. Second, we'll go after these companies to help you knock off your CapEx in transportation. What does that mean? So we potentially will go after this like $15 million spend revenue company, for example. I'll say, give us a region to execute. We will own the operations. We will own the people. We will own the technology. We will execute those shipment transactions for you. And as you see opportunity of optimizing, as we reduce your spend, as we increase your utilization rates, give us other regions. At the same time, we're also telling that there is an opportunity for you to knock off your CapEx completely because we are going to be a shared service model and we are operating across 100 different companies. So that's the opportunity here.
So then, you know, it still doesn't do TAM, right? This $15 million is what they're spending today, you're saying. But 15 million, you're telling them that we want to reduce your 15 million down by whatever X percentage, and then you take a percentage of that percentage. So let's say you want to slash their 15 million down to, you know, 8 million or 10 million, and you want to take 20% of that 10 million. Something like that is your real TAM.
Yes and no, because the markets which we're going after, potentially the companies which we'll go after are growing. And we're going to start with them in regions where let's say they have an OPEX of 2 million for Karnataka. We take the 2 million OPEX spend, which potentially becomes our revenue. We optimize that. So 2 million could go to $1.5 million in spend for them. But at the same time, that market should grow for them as a company.
It doesn't matter, but you see, market grows over time. You know, unless you're in a shrinking market, which you're not, market grows over time. That's fine, but you have to kind of model-wise, you have to agree to this. Like you're based on what you're telling me, your value proposition is to reduce CapEx and reduce OPEX. So you're taking the CapEx off, and you're also reducing the OPEX, and the more you can reduce the OPEX, the better. So let's say if you're starting with at a 15 million, your value proposition to your enterprise customers is that we're going to drop your 15 million OPEX to 10 million OPEX, and we're going to take 20% of that. So model this.
We're not taking 20% of it. We are taking the entire 10 million of it. The entire OPEX gets transferred to us. We manage their transportation. We become the logistics as a service company for them. Or we are the transport manager.
So then comes the big question: Are you investing in CapEx, or is your model a no asset model? Because if I know you're interested in fundraising. If you are thinking about investing in trucks, that is not going to be of interest. And I'm assuming that I've told you this before. So I'm assuming that is not the case. So that means that you're going to do this as a marketplace. You can take all of their revenues, but the truth is that is gross merchandise volume, or gross merchandise value, gross transaction value, whatever it is gross. Your real revenue is a percentage of that because it is a marketplace. You're bringing these onto your platform, and then you're distributing it out to truckers and transportation companies, small transportation companies, who are going to be actually doing the logistics work.
Yeah, I mean, I'm not denying that at all. The way we are looking at it is, for us, it's less about marketplace or technology play. It's more about disrupting the transportation space itself.
Yeah, but
and from a supply
let's talk investor language, Mithun. We are not interested in talking your language right now. We need to talk investor language. If you want investors to buy into your value proposition, we need to talk investor language.
Agree. So,
yeah?
on the supply side,
let me try to get agreement, and you need to repurpose the slide. So we need to get agreement on this. Figure out where your sweet spot is. Just like you did a wonderful job in 2 or 3 slides back, you did a wonderful job of showing here. You did a very nice job of presenting a larger picture and then zeroing in on where your sweet spot is. Do the same thing with this one. Where is the sweet spot? What size companies are we going for, and what is the level, and how does the model break down? So here, it is not 76 million that you're talking about. What you're gonna do is you're saying that you're gonna take a 15 million OPEX, drop it down to 10 million, and take 20% of that. That is your real revenue. So calculate TAM on the basis of that model and tell me what that TAM is. So this needs to be repurposed, and I will be happy to look at it after you've had a chance to rework these numbers and show what does that turn out to be.
Sure. We'll do that.
Because the minute you say you have any kind of CapEx-driven scaling involved, investors are going to freak out. So that has to be off your strategy.
Sure.
Okay.
Sure.
Go ahead.
We'll modify that. We'll modify that and get back to you there. So a little bit of competitive landscape understanding of what's happening there. There are legacy transportation companies like the Gatis, the VRLs, the APML, Agarwal and companies, TVS Logistics, and so on and so forth. And there are new and up and coming companies in the intra-city segment as well as in intercity segment. And we have a phased approach here to be part of this entire industry on a very large scale over the next few years. If you go to the next slide, please.
Is there any company in the logistics sector that is a standout company that has received venture funding?
Oh yeah, absolutely. So Blackbuck,
you need to call those out.
So Blackbuck and Revigo have raised hundreds of millions of dollars. Revigo is asset-based company. Blackbuck, I think Blackbuck is also an asset-based company right now. Porter has raised money from Sequoia, and most recently it was operating in the intra-city segment. Most recently they moved towards intercity as well. And Lot Trucks and Instavan has raised around $1 million or $2 million there, and they're operating in the intra-city segment.
So when you present this slide to investors, you need to discuss the venture activity in the space and kind of call out what is asset-based and what is non-asset. The vast majority of investors are not going to want to do asset-based, but there are more investors that are going to be open to doing non-asset-based deals.
Sure. Got it. We actually had a venture slide last time. I took it off into this slide. We'll add that. We'll add the amount of money they've raised and what are the differences between them and us. A few of our clients right now, we're working with Big Basket. Big Basket is grocery e-com company. We're working with Udaan, which Udaan is they want to be an Alibaba of India. Bisleri is the water bottling company, which has been very successful. We're also working with Delivery, which is a logistics company. We're doing the last mile with respect to hub to distributor segments. We are also working with Juvi and Flyjack. Juvi is a German-based solar company. Flyjack is Hitachi Transportation. Most recently, we acquired Metro Cash and Carry, and we're seeing good traction in our aggregation business. We still have to scale up to the next stage of our business in terms of providing an entire solution, and we're working towards that. If you go to can you move to the next slide, please? So from a timeline standpoint, today we're mostly working in the intra-city segment. We've done some testing in the intercity segments. We look at being we are on the hook right now to launch our on-demand service by end of next month. And over the period of this year and next year, we'll start getting into logistics as a service, wherein we talk about owning up the entire transportation spend for an organization, because we are a shared service model for any of those large enterprises.
So the companies that you have today, what is the model in which you're working with them?
It's the aggregation between intracity and intercity.
And it's an asset-free model though, right?
It's asset-free. Yeah, we are 100% asset-free. Our asset is based on supply aggregation strategy. We have we have a supply strategy, and we're working through a driver cum owner network as well as a transporter network.
Okay, all right. Now, what is the where do we understand how much are you making right now? Do you have a slide on that?
We just hit $100,000 in revenue for the month in December, and we're trending $1.2 million.
$100,000 in gross. That's gross transaction value.
That's right.
And so your revenue is 20% of that, 10% of that. What are you saying?
We closed the year at 15%. We closed 2017 at 15%, 15.6% approximately.
Okay. So 2017, what was the annual revenue?
$350,000 in terms of gross, and around $45,000 in terms of gross margins, overall margins itself.
Okay. And right now you are at about $15,000 monthly.
That's right. 25, actually more than that. We are at $45,000 if I'm right, approximately monthly.
15% of monthly. And what is the burn rate? What kind of burn rate are you working with?
So margins, we are seeing our margins go up and down based on our supply strategy because of ad hoc and available capacities. We are still small in the marketplace today, so sometimes we have low burn rate. But on a gross margin level, compared to some of the other companies we spoke about, most recently we're talking to Site Partners and Matrix Ventures. They looked us up and they spoke about each individual unit level basis as well. They found us to be the only company in Bangalore, compared to Porter, compared to Instavan, compared to Blowhorn and a couple of others, where we are gross margin positive by unit basis. And we are talking to them actively right now, and that's what we're seeing.
So
on unit basis, we're gross margin.
So the question that I'm getting at, Mithun, is this a very capital-intensive company to build, or is it a company that can be built capital efficiently?
It can be built capital efficiently because we will not own the assets. We might bring in different strategies around supply acquisition and management of the supply itself. We could work with large trucking companies. We have continuously spoken to companies which have like 200 trucks, 300 trucks, but no technology. Carrying and forwarding companies, similar to the third-party logistics or the fourth-party logistics companies in the U.S. There are a lot of them that have like 100 trucks, but 100 to 200 trucks, but unfortunately, they're dependent on somebody like an Expediter or a Kuehne+Nagel for technology. So we could help them connect the supply and demand, reduce inefficiencies there. Currently, we're looking at a $2 million seed round to fuel our 18-month plan. We are in 3 cities: Bangalore, Chennai, and Hyderabad. Bangalore is probably accounting to 90% of our revenue. We're still testing Chennai and Hyderabad. We have not, we are spread too thin in terms of our people right now to open up the new geographies, and that's where we are right now.
There is no need to open up lots of geographies. You need to prove the model more than anything else. You know,
that's right.
Opening geographies is a matter of capital. It's the model. Whether the model works or not is what really determines what the funding situation.
Yeah.
The other point I will make is in the Indian market, raising 2 million seed in convertible note is not an easy thing to do.
Yeah. We are a Delaware C corporation based out of US and India being subsidiary, so we're raising all our money here right now.
Yeah, but you're an Indian market-facing business.
That's right.
You can be incorporated here, but the vast majority of the traction you'll get funding-wise, there may be a few companies from here who would be willing to invest there, but because you're an Indian market-facing company, you're not a company that is, catering to the global market. This is an Indian market-facing company, so getting $2 million seed is not going to be easy with this idea. So we need to think about it. We need to kind of figure out what is the right strategy. If you go to raise $2 million right now, it's going to be an equity round. So you may have to do it in 2 steps to take a smaller convertible note seed or a smaller seed, even whatever, and then you may have to do this in 2 steps.
Sure. We'll talk about it more in the evening as well. I would.
Yes, exactly.
I'm seeing traction right now up to $1 million. I have commitments up to under 500,000 right now. But mostly convertible note, keeping it very simple. But I'm happy to take more feedback there as well.
If you can get already commitment for $500,000, $1 million in convertible note, I would close that round. Let's discuss it tonight when we meet. I would close that round because you can leave it open, and if more things come up, we can always talk to other investors and so forth. But just note that 2 million seed, given where you are and given the fact that it's an Indian market-facing deal, is not that easy.
Yeah. Got it.
Okay, so definitely, if you can, for tonight, if you can repurpose your bottom-up TAM like we discussed and bring it to that meeting, so we can quickly go over that. That would be very helpful for me to assess where we are.
Sure, Shana. We'll do that.
Okay.
How do we look at spending this money? The user proceeds itself. We're looking at accounting to 35 to 40% going into R&D, other 25% in operational expenses, other 25% sales and marketing. We have 0 sales and marketing today. The entire customer acquisition has been through supply chain and logistics references and connections in the past. We have completely been in supply chain logistics for the last 16 to 17 years. So that's how we have shown value right now. Next slide, please.
So you're moving very well. Lots of things are very good and very well executed, very well thought through. We have to tweak some of the investor language and just kind of figure out the nitty-gritties of the financing strategy going forward. So we'll figure that out.
Sure, Shravan. Thank you. Can we
All
move
right,
to the next
see you
slide?
tonight. Oh, you have more?
Slide.
Go ahead.
All we're saying is we're trying to disrupt the Indian logistics market, a two-sided marketplace potentially. We have a strong early team, strong traction, and we're raising $2 million in seed.
If you can position this as a two-sided marketplace, even if it's enterprises that you're bringing onto the platform and then you are managing the whole execution. There is a case study in the curriculum called Work Market that does exactly what you're trying to do in a different segment, which is hiring freelance workers. Work Market brings enterprise.
Jeff Wells is the CEO of Work Market.
Come again?
Jeff Wells is the CEO of Work Market.
Yes.
I met him, and I've taken feedback from him as well. Okay.
Anyway, his case study is in the curriculum. You can look at exactly how they're doing it, and it's a very similar model as yours. You will see in the template that we have for investor pitch, one of the points that we like to show is comparables, and I think Work Market would be an interesting comparable for you.
Sure, we'll look into that. I have not had a chance to review that content before.
Okay. All right, great. So see you tonight.
Sure, thank you very much.
You're welcome. Mir Ummar from Srinagar, Jammu and Kashmir, India. Go ahead, Mir. Unmute your line and tell us what you're working on.
Hello. It was great listening to you and Daniel in the first part of this conference. Again, Mithun doing very good. Was uh, literally paying great attention to this, all the insights and all. Well, I'm not that much prepared because it's relatively very early, as compared to
That's okay.
Mithun. So. Basically, I'm working on a startup from some time. It's called DairyMoo. So this basically aims providing pure milk to the people of the the cities basically, which are getting populated day by day, uh, where there is huge dearth of pure milk by using innovation and technology and modifying the supply chain, and most importantly, empowering the small dairy farmers by paying adequate prices and loyalty-based program. The issue for the small farmers in India has been, like India and the developing countries, we can say, it has been very bad for them in the past couple of 2, 3, 4 years. Because of there has been a very low demand of skimmed milk prices in the international market, so that has caused to bulk up the what do you call it, the production of skimmed milk products. So the companies, the corporates, they just want to suck up more profits, uh, and in return they pay very low wage for these prices to the farmers. So basically what happens is there has been around 2 lakh tons of SMP dumped by the government. So big dairy processors, cooperatives such as Amul, etc., they are pumping the same milk and importing the butter fat and other contents of the milk from the US and the European Union, and selling the same product in the market in case of the as a substitute to the pure milk. So that there have been reports. There was a report written in 2015 where these corporates are sending back the milk to the farmers, complaining of the the impurity in the milk and other such reasons. So that has been, pushing the small dairy farmers out of business. So, and this has, a great impact on the lives of the farmers, their healthcare, education, and also there are large dairy farms present in present in India, whose the average uh, uh, price of producing the milk, getting the milk, getting the milk from the cow is relatively lower than the small farmers who have 1 or 2 cows. So they are forced to sell it less than what the costs they have actually incurred in getting the milk from the this what do you call the cow. So I belong to Srinagar, where there are around we can say 80 to 90,000 families, and living in this city for my initial 7 to 8 years, and after then moving to I can say outskirts of the city. So I can say there is huge dearth of pure milk. There are majorly these milk processing plants in the city, which are producing. One is producing around 50 to 60,000 liters of milk per day. The other is producing around 20 to 30,000 milk per day. But what the problem is, the customers are hugely unsatisfied with the quality of the milk produced, and there have even some years back, or I can say some months, sorry, yeah, probably a year back, there was a case on such one of the plants where there was a penalty imposed of rupees 20 crore on them. So the city is expanding. There were small dairy farmers. Some 30 to 40 years ago, people had cows, or like uh, 5 out of 10 the houses had their cows at their home, and they used to use the same milk. But uh, as the city expands, the population swells. So, and there are many health concerns as well. There are people who are paying
So,
even
Mir,
five.
talk about how you are going to do this business. Are you proposing to set up a milk processing plant? Well, how are you going to solve this problem?
Yeah, exactly. So what I would be say, see, this started has been, you can say, around the story of the problem of small farmers, and at the same time the problem of the people living in the city, right? So we'll be setting a milk processing plant located in outskirts of Srinagar city, where we would be supplying milk from the small farmers using the technology automatic milk collection units from the nearby 3 districts, namely Pulwama, Badgam, and Ganderbal. So they are known for the pure, mainly pure milk production as compared to other states. So that would be processed in our plant and would be supplied through, we can say, a mobile-based application which the customers would use to subscribe to that to the daily milk supply. And again,
so have you talked, Mir, have you talked to small farmers who are willing to work with you in this mode?
Yes, as I said, I'm living on the, I can say, the outskirts of the city. We have the small farmers in this area.
How many small farmers have you talked to who are willing to join this cooperative?
Yes, I'm telling you. Yes, I'm telling that only. So we have small areas. We have talked to them. They have very deviation in the prices from time to time. The corporates give them. So what we have, what we are thinking about is to provide the fair rate. The government sets some kind of rate, which the procurement prices of the milk. So we will be procuring at a rupee or half a rupee more than the normal procurement prices, because there are still profits in this industry. The corporates are just sucking up the profits and not considering the case of the farmers, how they are going through it. Yes, they are very much interested. We have talked to them, and in addition to this, we would be.
How many farmers have you talked to who are willing to work with you in this mode?
It's around 10 to 15 farmers in the.
And what is the capacity? How much? If you work with 10 to 15 of these dairy farmers, how much milk can you bring under your umbrella with that supply chain?
The small farmers have 1 to 2 cows, everyone. If you talk about 15 farmers, that means they have 30 cows. 30 cows give around 15 liters of milk per day. If we take at the lowest, 30 into 15 is around 450 from a very small area, and that's we will be integrating all the areas from the districts.
So hold on, Mir. Can you please stay with me? Don't jump. I'm trying to understand your business. You're going to have to help me understand your business. So with these 30 cows and 15 farmers, what is the capacity of a plant? How much milk? How many cows does a plant need to be viable?
See, the capacity of the plants can be determined in liters. We would be aiming to install a capacity of 30,000 liters initially for the first 2 years, and we would be processing around 20,000 liters per day. And the milk would be sourced from the 3 districts, as I already mentioned.
And how many farmers does that correspond with?
That corresponds around with some, you can say, 1,000 farmers or 1,000 to 1,200 farmers.
1,000 to 1,200 farmers, okay. And what kind of a geographical area does that require you to cover? 1,000, 1,200 farmers. How much geographical area are we talking about?
With the geographical area, placing the plant in the Srinagar city, we'd be having 3 areas, Ganderbal, Pulwama, and Badgam, which are located at around 15 plus, you can say.
So these 3 villages are enough to feed one plant?
These are not the villages, these are the districts.
These are the districts. Okay, these are 3 districts that are enough to feed this plant that you're talking about.
It would be enough to feed the plant.
And how many consumers do you need to consume the milk that this plant produces?
see, the consumers we can take as in families because
Yeah, family. How many families do you need?
so we are catering about 15,000 families would be taking this, somewhere around 12 to 15,000 families would be
12 to
taking this.
15,000 families, and that you're going to access 12 to 15,000 families in Srinagar?
Yes, in Srinagar.
In Srinagar. And what is the cost of this plant?
The cost of plants varies from company to company, but somewhere around it will cost around 1.5 to 2 crore rupees. End-to-end solution. I'm not talking about the plant, but end-to-end solution.
Yeah. So your choice, basically, this is not the kind of things that, the investor network that we work with invest in IT companies and IT-enabled services companies. They don't necessarily go fund, plants and stuff. So, however, the Indian government has, small business financing for manufacturing and small business sectors. You're going to need to look into that through your local banks. SIDB, Small Industries Development Bank of India, and stuff like that. Those are your options. I think you need to look in the Indian small business financing sector through local banks.
Where do I get this technology into this? It is an IT into this. The supply of milk won't be like the other. The current mode of supply is the milk processing plant drops the poly packets to the retailers in the markets, and the people purchase from the retailer. What our venture would be doing, we'd be having a mobile application as well as a website where a customer would be subscribing to the daily need of the milk and other products which we would be processing, right? And from there he can manage his requirements, and he can add or reduce whatever the requirements.
That's all very well, Mir, that's all very well, but you have to get to a significant level of proof of concept before anybody is going to finance you from the IT industry. Because right now, it is not so much all that. There's all sorts of logistics and proof of concept of what your model is and so forth. None of this is currently financeable within the IT industry. If you can do a proof of concept and show that you can do one plant, you can cater to 15,000 customers who are subscribing to your service through a mobile app or a website and so forth, once you can do the proof of concept of all that, then IT industry investors may be looking at it. Right now, I don't think they will.
Okay, so as the questions are on the screen, what are the immediate steps you think I should be taking right now?
I think you need to figure out how you finance a plant and some working capital through your local banks or friends and family financing.
Okay, fine.
And get to a viable business with one plant, let's say 15,000 customers and whatever number of farmers you need to feed this consumer base and the plant. So just think, right now, don't think big. Just think about getting a local Srinagar operation with one plant, let's say about 12 to 15,000 families, and the number of farmers that you need to cater to, let's say 30,000 farmers, whatever number of farmers you need to cater to this plant, to get the supply for this plant, make this equation work at a small scale and build this business. If you can build this business and show that it all works, then we can take it to investors and get it financed to scale. But until you can show proof of concept, this is not going to be ready for IT industry investors. So you have to work with your local, contacts, local banks, friends and family to get this small proof of concept operation going.
Right.
Going and viable, and viable.
Okay. I would like to add something to it. Lately I mentioned about the farmers getting the loyalty points on for every liter of milk they sell to us and we process that, they would be getting the loyalty points which they can redeem for their health care, their whatever the requirements are, kids education, etc. So we are adding that part to it. So how do you think we can add that up to the
I
IT?
wouldn't complicate anybody's life doing all that peripheral stuff. Right now, you need to do a minimum viable product business, which is getting milk, sourcing milk from farmers, handling the logistics of storing and delivering and everything, getting the subscribers who are going to, the families who are going to subscribe. Don't complicate life. Right now, stick with just the basics.
Thank you very much.
Okay. All right. Yeah. It's an interesting idea, and I think I think it could be a reasonable subscription business long term. It could even be a big subscription business, but you're going to have to do a proof of concept and show that it works before you can attract investors from the IT industry.
I appreciate the feedback.
You're very welcome. How did you find out about 1 million by 1 million, Mir?
Basically, some days back, I joined the LinkedIn and scrolling, I just got to it.
Okay. I'm very happy to hear from you, and I'm thrilled to hear what you're trying to do. It sounds fascinating and very interesting, and I wish you all the luck in the world.
Yeah, thank you very much. And this is the first time like I was pitching to someone. So basically
that's
this
okay.
was built.
There's always a first time in every entrepreneur's life, so that's okay.
That's inspiring. And basically because this was built around the two stories, the one being the scarcity of pure milk in the cities, and the second one, the problem of the farmers they are facing right now.
No, yeah, I think what you're doing is a very reasonable thing to do. So I encourage you to do it. I encourage you to figure out the details. If you decide that you want help from 1 million by 1 million in thinking through how to put one foot before the other, we'll be happy to help you. But I'm just setting your expectations that don't come out to do this assuming that there will be a lot of financing available from the financing ecosystem of the Indian IT industry at the moment, because you're not ready for that. So we have to work outside of that. We have to work with local resources and get to proof of concept, and then there may be financing available.
Yeah, thank you. It was definitely a learning.
Yep, there's a lot of learning. You have a huge learning curve in front of you, and if you want to use 1 million by 1 million to traverse that learning curve, please feel free. We'll be happy to help you.
Yeah, sure. I might be disturbing you more in the future.
Okay. All right, folks. Thank you for listening to the pitches and the discussions. I'm going to spend a few minutes explaining to you how to use 1 million by 1 million, and then we're going to go to Q&A. So one request, if you like what we're doing here, please bring serious entrepreneurs into the program. All resources from our program are at 1Mby1M.com. There's a terrific blog. Just by following the blog, you're going to learn a lot. The Entrepreneur Journeys book series, there are 12 volumes of it. You'll learn a lot just by following those. These roundtables happen every week, so come to them. Over 60,000 people have attended them from all over the world. As you can see, we have a very diverse set of people coming from very diverse places, working on very diverse and very interesting stuff. The full acceleration program is our 1M1M premium program for extensive methodology guidance. We have a full online curriculum, lots of help with business development, strategy consulting, help with financing, help with media relations, getting the word out there about what you're doing, how you're doing, what you're doing. We charge a $1,000 annual membership fee for the premium program. Also look at the 1M1M self-assessment. Ask these questions of yourself vis-a-vis your business. If you get stuck on methodology issues, use 1M Basic to learn. That steep learning curve that you have to climb, 1M Basic is a very efficient way to climb that learning curve. It's a curriculum-only subscription, $99 a month, which is not going to break the bank, and you'll learn a lot just by studying the curriculum. Otherwise, dig around on the website. There's tons of information about what to expect from premium, what to expect from basic, FAQs, video FAQs about the program, lots of information about the curriculum. It is a case study-based program. We teach everything on the basis of what other people who have been successful have done before. There are 800 plus successful entrepreneurs case studies, including 50 plus unicorn entrepreneurs. There are 400 plus VC funded companies, 300 plus bootstrap success stories. So you're basically standing on the shoulders of people who have done it before and sharing with you how they've done it, and you learn from them. You implement what has worked, learn from what has not worked. Our methodology is lean, capital efficient bootstrap startups. Even if you raise money, you're going to have to bootstrap first, raise money later. In fact, Maureen, could you put on this slide bootstrap first, raise money later as a mantra, because I want to make sure that you understand that that is the only way you can really seriously raise money. You have to get to some level of validation before you can raise money. So we have one more free roundtable in February and 5 more in March. So please sign up to present what you're doing and work with me in a strategy session. And you can come meet me any Wednesday, actually, in February or March, including tonight. So hope to see you in one of these sessions. Any questions, folks? Now we're open for Q&A. You can dial in for questions. You can type in your questions in public chat. I'll be happy to pick up questions from the chat and answer them. And while you're doing that, let me introduce you to Irina Patterson. Irina at 1Mby1M.com, who'll be happy to answer questions about the 1M program. Anybody? Questions, comments? Shelly Gupta is asking, do I have to be a premium member to present in 1M? You don't have to be a premium member to present in one of these free roundtables. These are public free roundtables. You get one chance to pitch. You don't get to pitch over and over again. In the premium roundtables, you can pitch as many times as you want, and you can come discuss. In the free roundtables, you get one chance to pitch, but you don't have to be a premium member yet. Zaid Ahmed is asking how to join an investment fund as a limited partner. Oh, that's a very different question. You have to basically call up the general partners of the funds that you are interested in investing in and build their relationships. Mir Ummar is saying it was enlightening. Very good. Mir, I'm really thrilled to see that you found us from Srinagar and outskirts of Srinagar and came and presented. I am very, very happy to hear from you. Shelly Gupta, the premium member, you mentioned that you help with business development, investors, etc. So, Shelly, we have a very large Rolodex of, industry people, including investors, including potential customers, potential channel partners, depending on what you're doing, what your business is. So, on the financing side, we look at your business, we gauge fundability based on our knowledge and our experience, and not all businesses are fundable. If you are fundable, or if you have the potential of becoming fundable, then we'll help you through that process. Everybody who is introduced to investors has to go through a process of tweaking their investor pitch, strategy, et cetera, we'll help you through all that. We'll coach you through all that. And then when you are ready, we'll introduce you to our network of investors. You can go to the seed capital section of our blog. Maureen, you may want to put the link in the public chat so that Shelly can pick it up from there. And you start reading up and kind of immersing yourself in that section. You'll see we know a ton of investors. We work with a ton of investors. A ton of investors are part of our ecosystem. So, for example, we have a company that just started its funding round on Monday. And within 45 minutes, I introduced him to 33 investors. Now, of course, there was a lot of work that went into it before getting to that point where I can trigger 33 introductions. We did all that work with him, and once he was ready, we introduced him right away to 33 investors. So that's the process as far as financing is concerned. Now, business development, if we have relationships with people who can be potential customers for you or can be channel partners for you, we'll also connect the dots. Our Rolodex, if you're a premium member, our Rolodex is accessible for you. Anybody else? You're welcome. Anybody else? Any other questions, comments? Folks, you can always reach out to Irina and ask more questions about the program and talk to her, and she'll be very happy to spend more time with you explaining to you the program. All right, we will see you, maybe some of you tonight at the rendezvous and the rest next week at the next public roundtable or at the next rendezvous. See you soon. Bye.